While most people are distracted by headlines and daily noise, trillions of dollars are quietly changing direction, and history tells us exactly what happens next. 30. $8 trillion. That is the size of America's national debt right now, not a forecast, not a future estimate, but the real number sitting on the balance sheet as we speak. If that figure feels abstract or distant, it shouldn't. Because while everyday life carries on, while people scroll endlessly, stream shows and argue over politics, something profound has been unfolding behind the scenes. The largest pools of capital on Earth have begun shifting away from dollar-based assets, not loudly, not dramatically, but methodically, steadily, and with purpose. This movement isn't based on rumors or speculation. It's visible in filings, treasury reports, and international capital flow data that anyone willing to look can verify. By the time you reach the end of this discussion, you'll understand what's happening, why it's happening now, and why the consequences will reach directly into everyday financial life. More importantly, you'll see that this moment fits into a recurring historical pattern, one that has repeated itself with striking precision for centuries. Global debt has reached unprecedented territory. According to international financial data, worldwide debt has climbed beyond $250 trillion, representing well over twice the value of global economic output. The United States alone added more than $2 trillion in new debt in less than a year. These aren't small fluctuations or temporary anomalies. They are signals. And history shows that when these signals appear together, they tend to precede major financial turning points. This exact configuration, rising debt, monetary expansion, and silent capital rotation, has occurred before, not once, not twice, but repeatedly. And every time, the dominant financial power of the era experienced a rapid loss of stability shortly after major institutions began moving their money elsewhere. The reason this matters is simple. Large-scale economic collapses don't begin with panic, they begin with repositioning. And there is a well-documented cycle that explains how these transitions unfold. Across the last 500 years, dominant financial empires have followed the same four-stage progression. The first stage is ascension. A nation becomes the heart of global trade and finance. Capital pours in. Its currency becomes widely accepted, then dominant. Markets expand, innovation accelerates, and optimism is nearly universal. This phase can last decades, sometimes close to a century. The second stage is overreach. Success breeds confidence, and confidence gradually turns into excess. Governments spend more freely. Debt rises faster than productivity. Military commitments grow. Social programs expand. Central banks support the system by increasing money supply. Asset prices surge. Stocks rise. Real estate booms. On paper, wealth appears to multiply. The illusion of prosperity becomes self-reinforcing. This phase can persist for a long time, masking the structural damage forming beneath the surface. Then comes the third stage, the most important and least understood, the quiet exit. This is when sophisticated investors, institutions, and wealthy entities begin reducing exposure. They don't announce it. They don't cause headlines. They rebalance portfolios, diversify internationally, and slowly reduce reliance on the dominant currency. To the public, everything still looks fine. Markets may even continue rising. But beneath the surface, confidence is eroding among those who understand the numbers. Historically, this phase lasts only a few years. The final stage is the reckoning. Confidence breaks. Currency dominance fades. Inflation accelerates. Interest rates rise sharply. Asset prices fall together. Banks and pension systems come under pressure. Political instability follows. And only then does the broader population realize what has been happening all along. The common question is always the same. How did no one see this coming? The answer is that the pattern was always visible, just ignored. This isn't theory. History provides clear examples. In the 16th century, Spain stood at the center of global wealth. Precious metals flowed in from across the Atlantic. Spanish currency dominated international trade. Military power was unmatched. Yet unchecked spending and endless borrowing hollowed out the system. When creditors quietly withdrew and demanded hard repayment, the structure collapsed. Defaults followed. Inflation surged. Spain's dominance vanished. The next center of gravity shifted north to the Dutch Republic. Amsterdam became the financial capital of the world. Trade networks spanned continents. Financial innovation flourished. But war expenditures, speculative bubbles, and hidden banking practices undermined the system. When confidence finally broke, capital fled, institutions failed, and Dutch dominance ended almost overnight. Britain followed. For more than 2 centuries, its currency anchored global trade. Its financial institutions funded projects around the world. But 2 world wars, relentless borrowing, and mounting obligations weakened the foundation. Long before the public recognized the decline, capital and talent began relocating. Eventually, devaluation and international bailouts confirmed what insiders already knew. The era had ended. Each case followed the same structure. Each unfolded faster than expected once the third stage began. And in every instance, the public narrative lagged far behind reality. Now consider the modern era. After World War II, the United States emerged as the undisputed financial center. The dollar became the backbone of global trade. Capital flooded into American markets. This period of dominance lasted decades. But in the early 1970s, constraints were removed. The currency shifted from tangible backing to trust alone. Over time, spending expanded dramatically. Debt accelerated. Financial markets grew increasingly dependent on monetary support. In recent years, the pace has intensified, debt has exploded, money supply expanded faster than ever before. Asset prices soared across nearly every category. Meanwhile, wages lagged, inequality widened. These are not isolated issues, they are textbook characteristics of the late overextension phase. What makes the current moment different is that the third stage is no longer subtle. Foreign holders of U.S. debt have been steadily reducing exposure. Central banks are diversifying reserves. Trade agreements increasingly bypass the dollar. Major financial firms are adjusting strategies toward international assets, commodities, and alternative stores of value. Even domestic institutions have begun reducing reliance on long-term government debt. These moves aren't emotional, they're calculated. When a currency's global demand weakens, the implications are severe. Excess supply returns home. Inflationary pressure intensifies. Policymakers face impossible choices between defending currency value and sustaining debt obligations. Historically, neither path ends well. Liquidity dries up. Asset values adjust sharply downward. Systems built on leverage strain under pressure. Many believe this outcome can be avoided because of military strength, innovation, or institutional sophistication. But history shows that none of these factors override financial reality. Monetary systems fail when confidence erodes, not when power disappears. Printing money delays consequences, but it does not eliminate them. In fact, it often accelerates the eventual adjustment by redistributing wealth unevenly and undermining trust. So what does this mean on an individual level? First, it means understanding exposure. Concentration in any single currency or system carries risk during periods of transition. Diversification is no longer theoretical, it's practical risk management. Second, it means recognizing the importance of assets that historically preserve value during monetary instability. Third, it means acknowledging that geography matters. Capital flows where conditions are favorable, and individuals can learn from those patterns. Liquidity also matters. Flexibility becomes invaluable during dislocations. So does reducing dependency on variable rate debt in a rising rate environment. Beyond finances, skills and networks become critical. Human capital outlasts financial cycles. The ability to adapt, create value, and solve problems has survived every collapse in history. Most importantly, it means paying attention. Not to sensational headlines, but to structural signals. Economic transitions don't announce themselves loudly. They whisper first. Those who listen early have options. Those who wait for confirmation often face consequences. This isn't about fear, it's about awareness. History doesn't repeat exactly, but it rhymes with remarkable consistency. The same stages, the same behaviors, the same outcomes, over and over again. We are not at the beginning of the cycle. We are well past that, and the actions of global capital suggest that the third stage is already underway. The data is public. The pattern is clear. The only variable left is individual response. Throughout history, those who navigated transitions successfully were not always the wealthiest. They were the most informed and the most willing to act before the crowd.